Gold just dropped $233 in a single session while hitting $5,034 per ounce on February 9, 2026. But here is what nobody is telling you. While retail investors panic sold on February 5th watching gold crash from $4,815, central banks quietly added 863 tons in 2025. That is the upper range of expectations. And they are not stopping. The January CPI report drops in 3 days on February 13th. And every major player is positioned for something most people will completely miss. Welcome to Market Flux. If you are new here, I break down what is actually happening in markets while the mainstream media keeps you distracted. Subscribe right now because what I am about to show you about gold's movements this week could completely change how you position yourself before Friday's data release. Gold fell on February 10, 2026, as investor caution intensified ahead of key U.S. economic data. But here is the mechanism most retail investors completely ignore. Gold is not falling because the metal lost value. Gold is pausing because the U.S. dollar index is attempting a technical recovery. On February 9th, the DXY fell to 96.9013, down 0.75% from the previous session. Over the past month, the dollar weakened 1.98%. Over the past 12 months, the dollar dropped 10.54%. That is a massive currency devaluation. Gold priced in dollars must mathematically rise when the dollar falls, unless something interrupts that relationship. That interruption is the anticipation of Friday's CPI print. If inflation comes in hotter than expected, the Federal Reserve has justification to delay rate cuts. Higher rates for longer means a stronger dollar. A stronger dollar mechanically suppresses gold prices in dollar terms. If inflation comes in cooler than expected, the Fed has room to cut rates in June or September. Lower rates mean a weaker dollar. A weaker dollar lifts gold. Right now, the market is in a holding pattern. The DXY is trading in the high 96s to low 97s, near multi-week lows but showing signs of stabilization. Here is why this happened. Reason number 1, the January effect collided with geopolitical caution. January is when corporations reset pricing contracts and implement annual price hikes. Analysts warned that the month-over-month CPI reading could show a hot print even if the year-over-year trend is cooling. A 0.3% month-over-month core CPI increase would signal that the last mile of the inflation fight remains difficult. The market knows this, so institutional investors moved to the sidelines. The 10-year Treasury yield hovered near 4.1% throughout the first 10 days of February, reflecting a wait-and-see approach. Gold's price stalled because traders liquidated positions ahead of a potential volatility spike. Reason number 2, profit-taking after a historic rally. Gold rallied 65% in 2025. It posted 5 consecutive monthly gains through December and achieved a hat trick of positive annual returns. On January 29, 2026, gold peaked at $5,595.42 per ounce. That was the culmination of a 2-year move from below $2,000 to above $5,500. When an asset doubles in less than 2 years, institutional money managers lock in profits. It is not panic. It is discipline. The $233 drop from $4,815 on February 5th to the intraday lows that session was not a crash. It was a retracement. Gold rebounded to $4,931 by February 6th, then climbed to $5,013 by February 9th. That is a $198 recovery in 4 days. The asset is consolidating, not collapsing. Reason number 3, the Shanghai-London arbitrage spread widened to record premiums. This is the data point that 95% of retail investors will miss. The Shanghai Gold Exchange premium over the London Bullion Market Association VIX reached a record high in early February 2026. China is preparing for mid-February financial settlements. Physical gold is flowing east while paper gold in the west is being sold. This creates a divergence. Western investors see the spot price stall and assume demand is weakening. Eastern central banks see the spot price stall and continue accumulating physical metal at a discount to what they expect prices to be in 6 months. The arbitrage spread is a leading indicator. It tells you where the smart money is positioned. While you were watching gold's price action on February 10th, here is what the big players were actually doing. Central banks purchased 863 tons of gold in 2025 according to the World Gold Council. That figure is at the upper end of expectations and remains historically elevated. Meanwhile, retail investors were told a different story. Mainstream financial media focused on the price pullback. Headlines screamed about gold's volatility. Analysts questioned whether the rally was over. Not a single major outlet explained the Shanghai-London spread. Not one discussed why central banks are still buying at $5,000 when they were buying at $2,000 3 years ago. The narrative you were fed was, gold is risky. Wait for clarity. The action taken by sovereign institutions was, accumulate physical metal while paper markets create discounts. This is not the first time this pattern has played out. In October 2025, gold hit $4,381, then pulled back sharply. Retail investors panicked. Central banks added 53 tons that month, a 36% month-over-month surge and the highest single-month demand of the year. The metal rebounded, broke through $4,500 in late December, and then surged to $5,595 in late January. The institutions that bought the October dip made 30% in 3 months. The retail investors who sold the October dip bought back in at $5,400 in January, locking in losses. Gold purchases by central banks totaled 863 tons in 2025 and are expected to ease slightly to 850 tons in 2026 according to forecasts. But the trend is structural. The World Gold Council's 2025 Central Bank Gold Reserve Survey showed the strongest intention to continue buying gold since the survey began in 2019. 95% of surveyed central banks expected global central bank gold reserves to increase in the next 12 months. These are not speculative traders. These are monetary institutions managing sovereign balance sheets. Their time horizon is measured in decades, not quarters. They do not care if gold is $4,800 or $5,200 this week. They care that gold will be $7,000 or $10,000 within 3 years. And they are positioning accordingly. But now here is where it gets interesting. The historical pattern is unmistakable. On March 8, 2024, gold traded at $2,180 per ounce. The Federal Reserve had held rates at 5.25 to 5.50%. For 6 consecutive months, inflation was falling but still above target. The market expected rate cuts in June 2024. Then the March CPI report came in hotter than expected on April 10, 2024. Core CPI rose 0.4% month over month. What has not changed are the fundamentals driving this entire cycle. First, central bank demand remains structurally elevated. Even with the 2026 forecast of 850 tons, that figure is 80% above the 2010 to 2021 average. The World Gold Council's survey data is crystal clear. Central banks are buying gold to reduce reliance on the US dollar. 62% of surveyed central banks cited geopolitical concerns as a reason to hold gold. 58% cited inflation protection. These are not cyclical concerns. These are structural shifts in global monetary architecture. Second, the US dollar's long-term trend is down. The DXY has fallen 10.54% over the past 12 months despite the Federal Reserve holding rates at restrictive levels. The dollar index peaked at 114.78 in September 2022. Today it trades at 96.90. That is a 15.5% decline over 28 months. The cause is fiscal dominance. The U.S. federal deficit exceeded $1.8 trillion in fiscal year 2024. Debt to GDP crossed 122%. Foreign central banks are diversifying reserves away from treasuries and into gold, commodities, and bilateral trade agreements. This trend accelerates regardless of who controls the White House or Congress. It is a mathematical inevitability driven by unsustainable debt accumulation. Third, gold supply growth is stagnant while demand is rising. Global gold mine production has plateaued near 3,000 tons annually. Major discoveries are rare, or grades are declining. Extraction costs are rising. Meanwhile, central bank purchases averaged 1,029 tons annually from 2022 to 2024. Jewelry demand in India and China remains robust despite high prices. Exchange-traded fund holdings are beginning to rebuild after 2 years of outflows. The supply-demand imbalance supports a structurally higher price floor. Fourth, inflation has not been defeated. The Federal Reserve's preferred measure, core personal consumption expenditures, remains above the 2% target. Services inflation is sticky. Housing inflation is re-accelerating in select metro areas. Wage growth remains elevated at 4.1% year-over-year as of January 2026. The Fed may pause rate hikes, but they cannot credibly cut rates to pre-pandemic levels without risking a resurgence of inflation. This keeps real interest rates low or negative, which is the ideal environment for gold. On the record, here is my prediction. Gold will test $6,000 per ounce by June 30, 2026. Screenshot this. The catalyst will be the Federal Reserve's first rate cut, which I expect to occur at the June 18 Federal Open Market Committee meeting. The market is currently pricing in a 48% probability of a June cut according to CME FedWatch Tool data as of February 7th. That probability will rise to above 70% after the February 13th CPI report prints at or below expectations when the Fed cuts rates. The dollar will weaken further. The DXY will fall below 95 for the first time since March 2022. Gold priced in dollars will surge. The move from $5,000 to $6,000 will happen in 12 weeks, not 12 months. Scenario 1. The February 13th CPI report prints at 2.5% year-over-year or lower. Core CPI rises 0.2% month-over-month, below the 0.3% forecast. The dollar weakens immediately. Gold rallies 4 to 6% in the following week, breaking $5,300 by February 20th. The Fed signals rate cuts are on the table for mid-year. Gold consolidates in the $5,000 to $100 to $5,400 range through March, then begins the move toward $6.00 in April and May, probability 60%. Scenario 2. The CPI report prints hotter than expected. Headline CPI comes in at 2.7% year-over-year, unchanged from December. Scenario 3. A black swan geopolitical event disrupts markets. Examples include a major Middle East conflict escalation, a China-Taiwan military incident, or a sovereign debt crisis in Europe. Gold spikes violently, reaching $6,500 within days as safe haven demand explodes. Central banks suspend sales of foreign reserves and accelerate gold purchases. This scenario is low probability, but high impact, probability 10%. If you are holding physical gold right now, do nothing. Your position is sound. Do not sell into weakness ahead of the CPI report. The long-term trend is intact. If you are uncomfortable with volatility, consider your time horizon. If you need liquidity within 6 months, you should not be in gold. If your time horizon is 2 years or longer, a 5% pullback is noise, not a signal. Physical holders benefit from holding through data-driven volatility because central banks and institutions absorb dips. If you are trading gold with leverage or using futures contracts, manage your risk aggressively. Use the February 13th CPI release as a binary event. If you are long, set stop losses at $4,850 to protect against a hot inflation print. If you are sitting on the sidelines with cash, waiting for clarity, you have two decisions to make. First, determine your entry threshold. If you believe gold is going to $6,000, does it matter if you enter at $4,900 or $5,100? The answer depends on your capital size and conviction level. A 4% difference in entry price becomes irrelevant if the asset appreciates 40% over 2 years. Second, consider dollar cost averaging instead of trying to time a perfect entry. Allocate 25% of your intended position now at $5,000. Add another 25% if gold dips below $4,800 after the CPI report. Add the remaining 50% on confirmed strength above $5,300. This removes emotion from the decision and ensures you participate in the move regardless of short-term volatility. If you bought gold at the top near $5,595 in late January and you are underwater by 10 to 12%, do not panic. You are not alone. This is the exact position retail investors found themselves in during October 2024, when gold peaked at $2,790 and then pulled back to $2,650. Those who held recovered fully by December. Those who sold at the bottom locked in losses. Your decision depends on why you bought. If you bought because you saw a headline and chased momentum, you made an emotional decision and you should learn from it. If you bought because you understand the structural case for gold in a deglobalizing, de-dollarizing, fiscally unstable world, then the thesis has not changed. Hold your position. Average down if you have capital. Your entry price will be irrelevant when gold is at $7,000 in 2027. Watch these indicators closely over the next 90 days. First, the US dollar index. If the DXY breaks below 96 and holds, gold will rally. If the DXY reclaims 98, gold will consolidate or correct. Second, the Shanghai Gold Exchange premium over London spot prices, a widening premium signals. Physical demand is outpacing paper supply. This precedes price rallies by 2 for weeks. Third, central bank purchase reports from the World Gold Council and individual central bank disclosures. Pay attention to Poland, Turkey, China, and India. If these accelerate purchases in Q1 2026, it confirms the institutional bid is intact. Fourth, the Federal Reserve's rhetoric in press conferences and FOMC minutes. Any language shift toward acknowledging labor market weakness or expressing confidence that inflation is contained will trigger rate cut expectations and weaken the dollar. There are three types of people watching gold right now. The first type is panicking. They see the price stall at $5,000 and assume the rally is over. They are reading headlines that focus on short-term volatility and ignoring the structural data. They will sell this week if the CPI report disappoints. They will buy back in at $5,400 in April. They will repeat the cycle until they are exhausted and exit the market entirely. The second type is frozen. They want to buy gold, but they are terrified of buying at the wrong time. They have been waiting for a pullback since gold was $4,200 in September 2025. They are still waiting. Markets are the greatest wealth transfer mechanism in human history. Wealth flows from the impatient to the patient, from the emotional to the disciplined, from those who react to headlines to those who understand mechanisms. Right now, while retail investors are nervous about a CPI report, central banks are calmly adding physical gold to their reserves. While traders are setting stop losses based on technical levels, sovereign institutions are setting 20-year portfolio allocations based on monetary policy endgames. The question is not whether gold will go higher, the question is whether you will still be holding. When it does, gold just dropped $233 in a session while central banks added 863 tons in a year. That is not a contradiction, that is the entire story. One group is trading, the other is accumulating. One group is focused on Friday, the other is focused on the next decade. You get to decide which group you belong to. If this breakdown gave you clarity, hit the like button right now. Subscribe to Market Flux because I will break down the February 13th CPI report the moment it drops and show you exactly what it means for gold's next move. Share this video with someone who is nervous about their gold position right now. They need to see this. And drop this exact phrase in the comments, still holding. Let me know you are positioned while everyone else is panicking. I will see you in the next one.